If you're a Canadian right now and you are juggling multiple debts, life can feel really heavy right now. What started off as maybe a small credit card balance might have ballooned to something in the tens of thousands of dollars. It's affecting how you sleep, how you eat, and obviously your relationships, but it does not need to. A mortgage refinance might absolutely be the answer to help you get out under that mountain of debt. There's no magic here. We are simply doing math in order to restructure. On a very high level, if we have high interest debt, say at anywhere from 10 to 20%, by moving that debt into your mortgage, which is generally going to be in the low 4s to mid 4s at around this time, it's going to give you a much lower interest cost and you're much more able to service that debt. I'm also going to show you how to stay on your exact same amortization while also lowering monthly payments. I'm going to do all of this in today's video through a calculator that I have. If you're interested in running a specific scenario for yourself, please reach out. I'd be happy to help and get you out of debt. Keeping in mind today's video is for educational purposes only. Make sure to reach out to the proper professionals to make sure that your specific scenario would work for a debt consolidation. So here we have a very common scenario in Canada right now. We've had someone who's owned their home for 5 or 10 years. They're coming up to renewal and they're wondering, is there any way to restructure this so I don't have a ballooning cost of my mortgage? Or is there a way to help me consolidate some of this debt? I'm going to show you how we can do both of those things with a debt consolidation refinance. So here's the scenario. Client has 20 years remaining amortization on their loan. Their current lender is offering them a renewal rate of 4.29%. They do have a decent amount of equity in this property. They were able to take advantage of that upswing in the early 2020s, just coming out of COVID, where real estate absolutely blew up, and now their property value is at $750,000. They owe $400,000 on this property, but they do have quite a bit of equity, $350,000. But because we've seen this drastic rise in interest rates, maybe they had 1.99, 1.69 previously, now their mortgage payment is jumping up to $2,477.39. But the mortgage payment is not the only thing that has gone up in this time. This client has also accumulated quite a bit of debt, and this is very understandable. Groceries are really expensive, gas hasn't come down a lot, and we're also just seeing this higher cost of interest. So for these clients, they have a MasterCard, a Visa, and a line of credit. Total debt coming in at $45,000 on this side. And so just at a 3% payment, keeping it on Visa, MasterCard, these cards are going to be at a 19 to 22% interest range. We are just factoring in a 3% cost for each of these debts, and that comes to a monthly charge of $1,350. So their total household debt, if we include their mortgage payment plus those credit cards and line of credit, is $3,827. Now what we're going to show the clients is an opportunity to do a debt consolidation refinance and really help them get back on track. So now if we go to the left side of the screen, we have here a scenario where we're going to extend the client's amortization out to 30 years. So essentially adding 10 years on the back end of their mortgage. Is this ideal? Absolutely not. It is a good thing to get rid of your mortgage, and by extending the amortization, you're extending the time that it takes to pay the mortgage off. But as I said at the beginning of this video, I have a plan for these clients to show them how to shrink that 30-year, but at the very beginning, we're going to give them access to the lowest possible payment. The interest rate on this, an average refinance with any lender is going to be around that 4.49% range. And then again, now we're just going to adjust the amount of money that we're going to pull from the property. So if you remember, we had an original $400,000 mortgage. The property value stays the same. Instead, this time we're going to increase their mortgage amount to $446,000 and some change. And the reason we've adjusted this number, or it's a little bit more expensive than that $45,000, is we're also including the costs of the refinance in the cost breakdown. Now, some lenders will cover the cost of the refinance. They will help pay the legal fees and cover off the appraisal, and some lenders don't. And so we want to make sure that we're budgeting for these clients They don't have any out-of-pocket cost, and it's just going to come from the refinance itself. So at the end of this process, the client will be $0 out of pocket. Now, the first thing that we notice when we get to their monthly mortgage payment is because we've extended their amortization by 10 years, they have a monthly payment savings. Before, we were at $2,477. Now we're sitting at $2,250. Call it a savings of just under $250. So again, we are reducing the cash flow load on these clients, making life more comfortable. And most importantly, we have completely wiped out the client's MasterCard, Visa, and line of credit. This is now at a $0 balance. So the only monthly household cost that we have to worry about from our previous scenario is the mortgage payment of $2,250, and this results in a total monthly savings of $1,577. So imagine if you're in this exact scenario, and I run into clients all the time where this is very common. We're carrying large debts that have high interest costs, and it's really hard to get out from under them. So if you could hit the reset button and all of a sudden add $1,577 to your monthly cash flow, you'd likely be pretty happy. So that's our base case scenario. Now, I did say I did have a way of getting us back to that same amortization. So I'm going to show you a page that will, how much money of this $1,577 needs to be reallocated back to the mortgage to keep us on the same track. All right, so I ran this calculation earlier and I've dragged it into the spreadsheet. Here is our screenshot. We have our original mortgage balance of $447,000 at the interest rate of 4.49%, an amortization of 30 years, and then we have our monthly payment. Now, if we take $600 of that $1,577 savings and we apply it as a prepayment, we can stay on the exact same amortization we were in our previous scenario. So by eliminating that high interest debt and rolling it into the mortgage, we can make an extra prepayment of $600 to stay on our 20-year amortization and still have an extra $1,000 per month that we would have been servicing before. This can go into an emergency fund. We could divert all of that $1,577 into paying down the mortgage. However you wanted to structure this that would be good for your family, you could do. So I hope this has opened your eyes to the potential, and if you are sitting on equity in your property and you're struggling with high interest debts, you absolutely should be considering a refinance with a debt consolidation. I hope you enjoyed today's video walkthrough of a debt consolidation. Again, this works for basically two scenarios that we're seeing right now. Number one, you are suffering from interest rate shock. You had a very low interest rate that now you are renewing into higher interest rates, and you're looking for ways of keeping that payment very similar. Or perhaps like this client, you have a lot of high interest debt and you are looking to consolidate it into that lower monthly mortgage payment, and also looking for some help in making sure that you're staying on track with paying off your loan. I am a licensed mortgage broker in Alberta and Saskatchewan and would be happy to help run some scenarios for you to see if we can get you back on track. Even if you live in another province, I can still connect you with the right professionals. Please check out the description of this video for ways of connecting with me. If you enjoyed this video, you're gonna love this one as well.